1. What does doing nothing mean in investing? First, the concept must be understood correctly. Here, doing nothing does not mean lack of planning, lack of control, indifference. It actually means avoiding unnecessary transactions, not reacting to short-term volatility, staying loyal to a long-term plan. In financial literature, this approach is typically described as passive investing, a buy-and-hold strategy, or behavioral discipline. 2. What does doing nothing look like in practice? In investing, doing nothing means not constantly buying and selling, not changing your portfolio during panic, not reacting to daily price movements, not disrupting your long-term plan. This approach is commonly associated with buy and hold, holding assets for an extended period. What do academic studies say? One of the strongest pieces of evidence. Research examining investor behavior consistently shows that investors who trade frequently tend to achieve lower performance. One of the most well-known studies in this field was conducted by Brad M. Barber and Terence O'Dean. Their findings: investors who traded more earned lower net returns. Investors who traded less achieved higher performance. This revealed a critical truth in investing. Most investors underperform because they are too active. Behavioral finance research suggests that the biggest enemy of investors is not the market, but their own behavior. 2.1 Behavioral mistakes. An important concept in academic literature is the disposition effect. According to this behavior, investors sell winning investments too early, hold losing investments for too long. Research shows this harms performance. It stems from loss aversion and the psychological desire to lock in gains. This mistake often appears when there is constant portfolio monitoring, short-term price-focused thinking, panic or overconfidence. Ironically, the more active the investor, the higher the likelihood of mistakes. 2.2 As trading increases, performance may decrease. Common findings in academic finance: more trading, higher costs; more trading, more psychological errors; more trading, lower average returns. Because most investors cannot consistently time market movements correctly. 3. The biggest advantage of doing nothing: cost reduction. Every investment transaction includes hidden costs: commissions, bid-ask spreads, taxes, slippage. These may seem small, but compound significantly over time. Doing nothing minimizes these costs, increases net returns, accelerates portfolio growth. Many studies show excessive trading is one of the main factors that reduces performance. 4. Markets are chaotic in the short term, more predictable in the long term. Financial markets have two different natures. In the short term, news flow dominates. Speculation is intense. Emotional volatility is high. In the long term, company growth, economic development, productivity improvements. Long-term investing aims to participate in economic growth rather than short-term noise. 5. Behavioral finance. The investor is the biggest risk. In investing, the greatest damage often comes not from the market, but from the investor's behavior. Doing nothing reduces these psychological mistakes: overconfidence, believing you can predict the market; loss aversion, panic selling during downturns; FOMO, fear of missing out, rushing into rising assets. The common outcome of these behaviors: buying at the wrong time and selling at the wrong time. The hardest part of long-term investing is not the market, it is human psychology. Research shows stocks are naturally volatile. Protecting investor psychology during volatility is crucial. Emotional resilience plays a critical role in long-term success. Often, excessive trading is simply a psychological reaction. 6. Real investor experiences. Community discussions often align with academic findings. Many investors admit, "If I had done nothing, I would have lost far less. Acting quickly during volatility hurt me twice." Fast decisions are often made in the middle of market turbulence. The time factor: compound growth. Doing nothing allows the most powerful mechanism in investing to work: compounding. Compound returns mean Reinvesting gains. Growth accelerating over time. Active traders often interrupt this compounding process. 7. The risk of missing the best days. Financial research shows the market's biggest up days are unpredictable. They often occur within short periods. Missing just a few of these days can dramatically reduce long-term returns. An investor who does nothing, does not miss those days, captures long-term growth. Why waiting is sometimes the best strategy. 7.1 Compounding needs time. Returns are rarely linear. Early years, slow growth. Later years, exponential growth. Frequent trading can interrupt this compounding effect. 7.2 Transaction costs erode returns. Each transaction creates commissions, taxes, spread costs. Over decades, even small costs significantly reduce total returns. 7.3 Market timing errors are common. Timing the market is difficult even for professionals, is even harder for individual investors. The biggest gains often occur on a small number of strong days. Missing them severely damages performance. 8. Professional investor perspective. One of the world's most successful investors, Warren Buffett, emphasizes that investing is often about patience rather than activity. Buffett's philosophy: the market transfers money from the active to the patient. This principle is widely accepted in finance. 9. Why is doing nothing so hard? Because human psychology dislikes inactivity. Illusion of control. Action feels like control. Movement equals progress bias. Doing something feels productive. Social pressure. Media and peers encourage constant action. Doing nothing does not mean being passive. The correct form of doing nothing is planned, is strategic patience, includes risk management. The wrong version: blindly holding poor investments, waiting without understanding. When is doing nothing the right strategy? If you are investing long-term, if your portfolio is balanced, if your core strategy is sound, if markets are temporarily volatile, if emotional decision risk is high. When might doing nothing be wrong? This strategy is not always correct. You may need action if your risk profile changes, your financial goals change, your portfolio becomes highly unbalanced, your core investment thesis breaks. Doing nothing must be conscious and strategic patience. The action bias in investing. The human mind often falls into this trap. If I am doing something, I am in control. This psychological tendency is known as action bias. But in financial markets, excessive action often causes harm. Patience often creates advantage. The hardest but most powerful investment behavior. Research and experience point to one conclusion. Investment success is usually about creating a sound plan, staying loyal to that plan. Because the greatest returns in investing often come not from choosing the perfect asset, but from holding the right asset long enough. A final powerful emphasis. There is a paradox in investing. The most profitable strategies are often boring. The most exciting strategies are often risky. And most investors struggle to accept. Sometimes, the best investment decision is making no decision. Conclusion: yes. In investing, sometimes doing nothing is the best strategy. Because it reduces costs, prevents behavioral mistakes, strengthens compounding, supports long-term growth, reduces market timing risk. But remember, doing nothing is not equal to lack of planning. Doing nothing equals disciplined patience.